Is Jerry Wattenberg, Managing Director at the consultancy JTW International. So is Larry Summers right when he says we're not paying attention to the signs here?
Well, I think the thing you saw over the last week is that the market is not pricing in substantial risk, even across even slight things in China. What you're seeing right now is one of the bigger concerns is that the oil price has been relatively stable, and any potential problems in the Middle East could obviously cause that to spike, and that would be then the biggest risk factor that the markets would face.
Let's have a look at Iraq, because that's interesting. That's the case in point, obviously, 4th anniversary. And if we look at what the markets have been doing, or certainly what the Dow has been doing, major US markets, equity markets have been doing, since then, what we're looking at is a good, steady climb, all the way up, a couple of blips, but essentially the start of that climb pretty much coincides with the Iraq war. It sounds as if, the war has actually been rather positive for markets.
Well, I think you got to look at a couple of things. The first thing is that European central banks and the U.S. central bank as well has been very, very clear in communicating to the market their views on interest rates. And so because of that, that's calmed a lot of the uncertainty that we had in the past. However, the risk still exists that there could be a situation whereby oil prices could spike, or a dramatic increase in inflation could then really put the markets on edge.
If one looks back at the last 4 years, clearly we mentioned North Korea, which is only just coming to heel, if at all, at the moment. Iran still hasn't been brought to heel, despite the fact that a lot of powers are lined up against it. Iraq, really, the limits of US military power have been demonstrated by all of that. It ought to be that the markets should be worrying that instability, which is obviously anathema to the markets, is actually increasing.
Well, I think what you're going to see is a repricing of the risk that's in the markets, and you saw that over the last few weeks where kind of everything was quite calm and looking rosy, and then all of a sudden the apple cart got turned over, and now I think you're going to see the markets being more sensitive to certain parts of the world, which maybe the expectations were that everything just grows to the sky, and all of a sudden now it's not the case. And so I think you'll see more volatility, and I think you'll see a repricing of different risk associated with different parts around the world.
Okay, so really we're going to, what that means, if I'm translating you correctly, is we're not going to be seeing that wonderful interest that we saw in emerging markets and that kind of thing, and people are not going to buy so many Chinese stocks and so on.
Well, I think you're going to see a more thoughtful approach to it, as opposed to just following the herd, because people now understand that they could lose money substantially in these emerging markets, and they've now got a little bit of a taste of it. Doesn't mean that the growth is not there, that people with risk and appetite for risk are going to put their assets there. It's just maybe the lay consumer and the lay person may not, it's appropriate to be in those markets at this time.
Jerry Wattenberg, thank you very much indeed.